Hello, I'm Sami Zaidan. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, out of pocket and out of patience, Italy's rich northern regions vote to make a break from Rome. Also this week, China enshrines the president's political philosophy into the constitution. What will it mean for the nation's pocketbook? Plus, cashing out, traders get ready to say goodbye to Hong Kong Stock Exchange as computers take their jobs. Now, millions of citizens in two of Italy's wealthy northern regions have voted to take more control over their own economic affairs. Echoing recent developments in Catalonia, Lombardy and Veneto have shown their unhappiness at their tax money being used to pay for services in poorer parts of the country. The result of the ballots were non-binding, but do say an awful lot about a desire to break away from Rome. Officials say around 5.5 million people headed to the polls to have their say in the referendum. Now, final counts showed 95% of voters in Lombardy said yes to greater autonomy, and this number rose to 98% in the Veneto region. The referendum was organised by the Northern League political party. It wants to cut the gap between taxes sent to Rome and the value of state services they get in return. Citizens feel hard done by. The Lombardy region says its shortfall comes in at around $64 billion, which it says is the highest in Italy. Veneto claims its shortfall comes in at $18 billion. So what's next for Italy as the two richest regions try to take back power from Rome? Well, joining us now from London is Russell Jones. Russell is an economist and partner at Llewellyn Consulting, an independent economics advisory firm. Thanks for joining us today. So what do you make of the economic impact of the Lombardy and Veneto referendums? Are they going to overburden the Italian economy?
Well, right now, what we're seeing is the Italian economy doing quite well, as is the Eurozone economy. But this is a reminder that beneath the surface, both in Italy and in Europe, there are a number of fault lines, both politically and economically. It is a reminder that the populist pressures, the pressures for regionalism still remain pretty strong beneath the surface. Does it represent a danger in the short term to national unity in Italy? Well, I think probably not. But there is a fear that this could be the thin end of a wedge, if you like. And over the course of the next few years, you could see this kind of development continue to gather impetus, to gather momentum.
But there is still a bit of a struggle, if not a challenge, when it comes to the debt to GDP ratio for the economy.
That's correct. Italy has a very high debt burden. I mean, the good news latterly is that the economy has started to grow again. And we should also remember that the Italian government does run a fairly large primary budget surplus as well. So the combination of growth and that primary surplus means that, at least for the moment, that debt burden is likely to come down rather than to expand. The problem for Italy comes, as it does for a number of peripheral economies in the Eurozone, the problem comes when there's next a recession and when that GDP growth dissipates, disappears. And once again, I think you would see the financial markets focus on those countries like Italy that have a very high level of sovereign liabilities.
When we talk about some of these movements for greater autonomy, is it all about the bottom line, the money that is fueling and driving these movements?
Well, certainly in the Italian case, the northern part of the economy is responsible for about 30% of GDP, and the states that held the referenda feel that they're not getting their fair share of influence and of tax revenues. So I think there is a sense that this is economic. The Northern League, which has long been a mouthpiece for greater autonomy for the northern parts of Italy, certainly sees these votes as an opportunity to expand their influence. So yes, I think economics is a very big part of it.
Whether we're talking about autonomy movements, separatist movements, referendums, is this, do you think, going to take a toll not only on the European project but on European markets as time goes on?
I think for the moment, as I said, I think the economic situation is pretty positive for Europe. I mean, finally, but the cyclical position of the European economy, and that certainly includes Italy as well, is in good shape. The problem is that a lot of the underlying fault lines and structural issues that Europe has still have not been addressed. The process of structural reform has slowed down a lot. The question you have to ask is whether structural reform or progress in that area is actually consistent with a situation where you have these populist movements.
Well, you asked the question, so let me turn it around and say that was going to be my next point, is can any of those structural reform challenges really be addressed now, given the sort of political environment that you were explaining there?
Well, on the one hand, there is a hope that a combination of Mrs. Merkel in Germany and Monsieur Macron in France can put their heads together and forge some progress on those reform policies. On the other hand, I think the problem with that is that there's still a reluctance to swallow any unpleasant medicine around the periphery. A lot of people are looking at what happened in Greece and are saying, do we really want to go down that direction? There is a great sense of reform fatigue across the euro area. I think personally that Mrs. Merkel and Mr. Macron are going to have a very difficult job in accelerating this process of reform. And my sense would be that when the next downturn comes, and it surely will come at some stage over the next few years, that a lot of the underlying issues which Europe has suffered from for many years, for decades, will once again reassert themselves.
All right, Russell Jones there. Thanks for your thoughts.
Thank you.
He's now officially the most powerful leader China has had in more than 40 years. The ruling Communist Party voted to add President Xi Jinping's name and ideology to the constitution. That puts him on the same level as Mao Zedong. It also suggests Xi will influence policy, including fiscal policy in China, for decades to come. We'll be talking to an economist about this shortly. But first, our correspondent Andrew Thomas has been to Liangjihe to find out more about President Xi's humble beginnings.
When Xi Jinping lived in Liangjihe in the early 1970s, it was a rural village where people lived in caves and in poverty. Now, people ride in on electric shuttle buses. Most villagers have left. Their home turned into an open-air tribute museum, honouring the man who's now president. Guides, some very young, tell a sanitised version of the Xi story. What he learned here, what he did here, and how loved he was. Visitors see the bed in which, though flea-infested, Xi is said to have slept. They hear how he built dams and dug wells. Most groups are brought here by Communist Party workers and photographed in front of Xi's wise words. Xi Jinping was born the son of a senior Communist Party member in Beijing, but in 1969 his father fell out of favour. The family was banished by Chairman Mao during the Cultural Revolution. At 15, Xi was sent to remote Liangjihe. He spent 7 years farming infertile land, living and working alongside some of the poorest people in China. They were his formative years. Xi became leader of the local branch of the Communist Party. He'd go on to more senior roles all over China until becoming president 5 years ago. Xi never forgot Liangjihe, returning for a visit 2 years ago. The village has become an important part of who he is, the president with the common touch.
I'm happy and excited. This is where Uncle Xi started his long march. All his hard work began here.
The official Xi story, one of hard work, honesty, innovation and empathy, means the president sounds authentic when he demands those qualities of party members and of the Chinese at large. This is essentially the theme park extension of the Xi Jinping brand. What these people have come to see for themselves is the setting for a story that hundreds of millions of Chinese people are reading about daily in state media and learning about in schools. At the entrance to Liangjihe, Workers are expanding the car park and building a grand ticket hall. 2,500 people already visit every day, but a lot more are expected for many years to come.
Well, joining us now from Hong Kong is Alex Wolf. Alex is the Senior Emerging Markets Economist with UK-based Standard Life Investments. Good to have you with us. So as we know, China is set soon to become the world's largest economy. What's driving the Chinese development miracle, as some call it?
Well, it's changed over time, but in one word, the short answer is reform. They've sustained very high rates of growth over a long period of time through progressive reform efforts that go back to Deng Xiaoping's reform and opening, when he unlocked avenues of productivity through agricultural reform, SOE reform, and opening up to foreign direct investment. Of course, that changed post-crisis when they relied more on debt, especially credit-fueled investment. And so it's very much investment-driven at the moment, and that's why you're seeing increasing levels of debt with structurally lower growth rates.
We'll come to the debt in a second, but can the long run of growth that you mentioned continue looking forward? If I get you to dabble into your crystal ball a little bit.
No, I don't think it's not possible. I think one of the things that has sustained growth over this long period of time, of course, has been demographics as well. They've benefited from what's called a demographic dividend, where they've had increasingly a larger labor share of the population. That also has fueled growth. But now China's facing a much different demographic situation, where demographics are increasingly going to be a drag. And so it's going to be very difficult, if anything next to impossible, to sustain the rates of growth that they're targeting, especially their target through 2020 with declining labor share of the population. And so the only way to really sustain high rates of growth is through increasing productivity. And to increase productivity, they'll have to launch very structural reforms that will be quite difficult, I think, in their system.
You mentioned a moment ago debt. Economists are warning it's being neglected. What can President Xi do about it?
Well, there's a long list of things he can do, and this list is relatively well known. In fact, they themselves published a list of what they think they can and should do back in 2013, in what was known as the Third Plenum document, that discussed SOE reform, so reform of state-owned enterprises, labor reform in terms of the HUCO household registration system, land reform, opening up sectors to foreign investment and to private sector investment, things that can unlock productivity growth, but also reform the relationship between the state and private sector. So just creating an even level playing field where the most productive firms can succeed and the least productive firms can fail and leave the market. But in fact, they're trending in the opposite direction. And a lot of what they talked about in the work report at the Party Congress was reforming the role between the private and the state, but in fact it wasn't reducing the role of the state, it was increasing the role of the state. And so this I think will make it very difficult to achieve the growth rates that they're targeting, especially if you would expect, as I do, that productivity growth will likely not bounce back without the reform trajectory that they need.
All right, Alex Wolf there, thanks so much.
Thank you.
Twitter says it could be on course to finally turn its first ever quarterly profit. The social media network has lost over $2 billion since it started in 2006 and has struggled since it went public in 2013. 330 million people use the service. Kobe Steel has taken another hit in the fraud scandal. It's lost an important industrial standard certification for some of its copper products. Japan's third largest steel maker recently came under fire after reporting it faked quality inspections. At least 500 companies are thought to be affected by the data fraud. McDonald's has seen its global sales climb 6% in the last quarter, topping analysts' estimates. Its chief executive, Steve Easterbrook, has been credited with winning customers back after the company suffered years of decline. Well, he's now investing in tech to ramp up home delivery and mobile pay services, along with shaking up the menus. Taking selfies might not be everyone's forte, especially for those of us who are a little camera shy, but you might want to work out what your best angle is. Banks may soon want our faces as well as our fingerprints and voices to verify who we are. Visa is set to launch a platform that allows banks to integrate various types of biometrics into approving credit card applications and payments. Still to come on Counting the Cost, end of an era, why traders at Hong Kong's last stock market floor are saying bye-bye to the bear pit. The Wall Street crash began this week, 88 years ago. A stark comparison to today. In the US, stock prices have more than tripled since 2009. But many investors are wondering if the current upbeat sentiment can last. There's political uncertainty and warnings of fiscal tightening by central banks, including the Fed. Christian Salumi has more from New York.
With a nuclear-armed North Korea making threats, international trade deals on hold, and a revolving door for White House staff, U.S. politics have been anything but predictable under the Trump administration. Nevertheless, stock prices have been steadily climbing, recently passing 23,000 for the first time, defying conventional wisdom that the market craves stability. Since President Donald Trump's election, the Dow Jones Industrial Average has shot up 26% and shows little sign of slowing.
There are some signs of some cracks in some of the most ebullient of forecasts, but generally still looks like we have further to run, particularly because markets are a little bit fixated on what so far has been a strong earnings season and some positive notes about possible tax reductions.
The market also continues to benefit from low interest rates and a policy of quantitative easing that started under President Barack Obama 7 years ago, starting the market on its current upward climb. But if history is any guide, this trend won't last forever.
And whether it's the stock market sell-off that led to the Great Depression in 1929 or Black Monday in 1987, the superstitious point out that the greatest market drops have taken place in October, and some warn that safeguards meant to stop such slides have not kept pace with modern technology.
Do I think that something like that can happen again? I mean, anything's possible. I think that with the advent of computer technology and the speed at which that technology is transforming the market, I think it's very possible. I think it would be a very quick move.
For now, however, with the possibility of tax cuts on the horizon, the market continues to skyrocket and investors hold on tight for the ride.
Well, joining me now from London is Jan Lambrechts. He's the Global Head of Financial Market Research at the Netherlands-based Rabobank. Good to have you with us. So, Jan, what's going on with the US equity market then? How is it defying all of this, shall we say, gravity of political uncertainty?
Currently it is indeed defying that. I think there's a couple of things really playing out at the moment. Obviously corporate earnings so far this season has been pretty strong and that helps. On top of that, the market's been very pleased with sort of the pushback against regulation. So the deregulation sort of angle that the Trump government the administration has, is landing very well in the market. At the same time, the market's traveling in hope. They're traveling in hope that the tax reforms will come with something, that money will be repatriated, and there's a simple math there that will all benefit stocks. So at the moment, a hopeful equity market posting one high after another.
Well, how much higher can the market get on hopes and confidence? Do you think it's going to continue to push the numbers north?
Well, so far it's been really good at defying gravity. Even the whole discussion about the Fed chairperson, of course, coming up has been sort of sidesteps, and there's quite a range of candidates there, so the market could be more worried about that. I think on deregulation they want to see more action, but particularly tax reforms is going to be absolutely crucial. If the Trump administration cannot deliver on that, there will be a bit of a reckoning in equity markets. Don't forget though, there's still a lot of central bank money sloshing around trying to look for returns. That is of benefit to these equity markets as well globally.
But there's also warnings, as I'm sure you know, Jan, that 60%, the bottom 60% of Americans are struggling. Are we being misled somewhat by some of these headline numbers?
Well, this is the big digger to me, the big paradox, of course. On the one hand, if you look at the asset classes out there, bubbles are forming, it seems. A lot of these markets are doing well. You can come up with structural reasons or not. They're bubbling up, of course, in part because central banks have been supporting it. But underlying that, in many of the societies globally, in the US is no exception there is a large underclass of people who are wondering how this recovery is working for them. They don't see the real wage increases. That's the big missing factor here. And that's, of course, where such statistics like 60% of the Americans struggling from paycheck to paycheck is coming from. It is real. It is really out there. It's not just politics. It is something that needs to be addressed. Central bankers have been in charge of addressing it, it seems, because politicians have taken a step back. I think politicians will have to do a step up in the next years to come, because central bankers have, used up most of their ammunition, really.
Well, I'm glad you mentioned step up and the slow wage growth. What does that mean for monetary policy?
It's the key missing ingredient in this current recovery. If we would have had wage growth at the moment, the central banks would have had no problem hiking rates. As it stands right now, they're gambling big with high stakes, trying to hike rates even at a gradual pace. Because if that goes wrong, they will be blamed for cutting the recovery short, they being the central banks here, of course, by all those people who, like I said, over the past decade have not seen their real wages increase. And they are really puzzled by it, central bankers. They don't have a clear answer to it. They're wondering whether the Phillips curve that dictates that as unemployment falls, wages would normally start rising is broken. And if it is broken, what does that mean for monetary policy? Do they have to come up with a new monetary theory, a new way of running these central banks? Those are some key questions out there. So far, very little wage growth to really go by.
Now, the market's also been excited about, talk of a tax overhaul by the US president. If that comes to fruition, who do you think it's going to help the most? Where is it going to leave things from a market perspective?
If you would have asked me that at the start of the year, Trump's plans were very much in favor of the wealthy. And that is a bit of an issue as an economist or strategist, because you're trying to lift real wages. If you're trying to really lift the economy, giving the biggest cuts to the wealthiest isn't really going to help, because they will just pile it in more asset bubbles, really. It's not going to be spent. There's only so much burgers you can eat in a day, after all, or steak for that matter. Now, as it stands in its current forms, it is more generous towards the entire population now, but we have to be careful because these plans are still being discussed, still very malleable, they're still being formed, so it's hard to get a verdict out there until we see it actually pass. That's a big if already, and if it passes, in what form?
Time will tell, I guess. Thanks so much.
You're welcome.
The trading floor in Hong Kong Stock Exchange is shutting down at the end of October. For 30 years, the exchange floor was full of energy and shouting as brokers in brightly coloured vests made and lost fortunes. All of that is ending now, thanks to online trading. Divya Gopalan reports from Hong Kong.
3, 2, 1.
With a bang and much enthusiasm, Goldrise, a China-based logistics company, debuts on Hong Kong's stock market. Initial public offerings from Chinese firms are becoming more frequent, with more than 1,000 companies from across the border trading their shares on the Hang Seng Index.
You have only with Hong Kong, within Greater China, this large equity marketplace that basically is accessible as long as you're a qualified company. So without government interference, you can easily come here, and with the size of China's economy, that just pushes more of these quality companies to the listing opportunity here.
Chinese entities account for about half the number of companies on the Hong Kong Exchange, compared with 5% in 1997, when the territory transitioned from a British colony to a special administrative region of China. Hong Kong has always been a financial hub, but over the past 2 decades, the nature of the city's markets have changed drastically along with China's economy. Chinese companies and investors looking for international exposure are now a huge part of the financial system. But there is another big change quietly taking place in the city's stock markets. The news that Hong Kong Stock Exchange is shutting down its trading floor by the end of the month has caught many by surprise, despite the fact that it's used by only a few brokers now. Online technology and trading by computer have made this place redundant.
Before we get so many friends and so many connections, we exchange the financial information with each other.
The exchange has shrunk over the years, but has always remained an important symbol. In the early 90s, a popular TV series captured the excitement on the exchange floor and the lives of traders in the red vests.
We think they are cool when I was a child, because they represent kind of the wealth and success of Hong Kong.
And now the clothes is like this is in another era of Hong Kong.
Although there are those who are less sentimental.
I agree they closed because actually they're not working in there anymore because everyone is prefer internet.
It's the end of an era for Yip Wing Keung, who has spent 30 years here.
It's the icon. Hong Kong is one of the world financial center. It's unbelievable. We see this. How can be a financial center, no trading hall?
From next month, the trading floor becomes a part of a museum dedicated to the stock market, making it yet another piece of Hong Kong's unique identity relegated to history.
And finally, my number of the week, $30 million. That's how much the world's largest known fancy intense pink diamond is expected to fetch when it goes up for auction. The Raj Pink is exceptionally rare and weighs 37.3 carats. Sotheby's auction house has been showing it off to prospective buyers in London and Hong Kong before it goes on sale in Geneva next month. That's our show for this week. There's more for you online at aljazeera.com/counting the cost. That'll take you straight to our page, which has individual reports, links and entire episodes for you to catch up on. That's it for this edition of Counting the Cost. I'm Sami Zaidan. From the whole team here, thanks for joining us. The news on Al Jazeera is next.